Okay, so I think we made it through all those attachments and on to the next item, which is board education.
And I will turn this over to Robin.
Robin?
So thank you for the opportunity to present this information. This is intended to be an education item for the ARM Committee related to trends in financial reporting as it relates to pension plans. And so we're here to share with you some upcoming changes that we anticipate being made by the Government Accounting Standards Board. As if we aren't busy enough with GASB Statements 67 and 68. We're going to talk to you about a statement that doesn't have a number yet, I don't believe, but we expect to see in 15, 16, so there's no rest for the weary here. And with me, I have Shafat Hassan, who's the senior manager in our investment accounting area, who has the depth of expertise to walk through this with you. My task is just to set it up. I want to make sure I acknowledge Shafat and her staff for all the good work they did in the analysis of this preliminary views document. We actually prepared a response to the GASB board. We participated in a field test, and there was lots of work involved with that. And I think you will see that that work has brought value to us in terms of understanding the impact of these changes, as well as hopefully value to the board in their deliberations around the changes, because we would anticipate that this transition would be very complicated and costly. So we wanted to make sure that we got the opportunity to provide that. So with that, I'll run through the agenda, and like I said, most of my job is just to kick this off. Shafat's going to do the heavy lifting, and she has staff to back her up. April and Conrad are back there in the audience, so if we get to the technical depth, we'll call on others. So again, we'll give an introduction in terms of the GASB process. We're going to talk about this fair value measurement and application project, the impact that we would expect to see to our financials at CalSTRS, issues and concerns that we have and responded to the board with. Again, this was our opportunity to provide that kind of commentary in response to the preliminary views document. We actually participated in the field test, and again, GASB uses field tests to try to get a feel for what implementation would be like under the proposed standards, and so they're looking for people to try them out as they're currently understood. Upcoming milestones, and then please interrupt with questions along the way. This is, again, intended to be an education item. It's obviously a fluid topic. It's not set in stone, and we'll try to address any concerns or questions that you might have. In terms of the GASB process, their process starts as projects. One can only imagine the initiation of a particular project. In this case, there's lots of conversation between FASB and the International Financial Reporting Standards Board about the differences that currently exist, and so I would conjecture that that's one of the things that caused this to kick off. There's a process where GASB staff, who are co-located with FASB staff, do initial research, so I'm confident that there's some bleed there. That research leads to agenda setting with the board. The board might establish a task force and advisory committee, so getting input from practitioners and preparers, and then they go into the due process period where they issue a series of documents depending on the nature of the proposed standard, and then stakeholders are given an opportunity to respond. And that's all I'm here to share with you, and then I'm going to hand it over with Shafat. And I'm certainly willing to answer your questions as we go through.
Okay. Thank you, Robin. I'm going to start with providing you a brief overview of the fair value measurement and application project that is being proposed by GASB. GASB first applied fair value to investments back in 1994 with issuing Statement 25. Now, this was about 2 decades ago, and ever since then, there have been additional statements and updates to existing ones, but they all have been very limited in terms of providing guidance as to applying fair value to investments. Moreover, they did not cover all the various types of investments that are held by governments today. You may recall that in 2006, FASB issued Statement 157, which is more recently known as ASC Topic 820. FASB 157 was passed to help investors and regulators understand how accurate a company's asset estimates truly were. It was GASB's understanding prior to issuing that statement that there were different definitions of fair value, and there was limited guidance for applying those definitions to the financials and reporting process. Today, GASB's thinking is similar to that of FASB's back at that time, and GASB believes that providing strong guidance in this area will lead to increased comparability, greater accountability, and a better measure of the resources that are available to governments. This project was first identified by GASB back in 2011, and it was at that time that the board thought of using FASB's Topic 820 as the starting point to define fair value. By 2012, the project matured further, and a scope was defined, and by June of 2013, the preliminary views were issued. CalSTRS responded to that preliminary views, as Robin mentioned earlier. The preliminary view really gave us a good opportunity to respond back to GASB and communicate to them our concerns and our position on what was being proposed. Within the prelim views, the project scope was identified, and GASB started off with providing a definition for investments. According to GASB, an investment is a security or other asset that a government holds primarily for the purpose of income or profit, and it's solely held to generate cash or to be sold to generate cash or procure services for the citizenry. This new potential guidance will be applicable to all the investments or assets that fall under this definition. GASB has adopted the hierarchy of inputs from FASB 157 and requires that classification of securities be categorized into level 1, 2, and 3. Levels are inputs, and inputs are the assumptions that market participants make in pricing an asset or a liability. An example of a level 1 security is a common stock that's priced daily in the active markets. Level 2 securities would use a combination of observable input and an unobservable input. For example, a pricing model for a muni bond. Level 3 securities are the most difficult to price. An example would be a private equity. They're usually priced using various models, estimates, and risk-adjusted values, and they rely heavily on the manager's assumption. The project also mandates additional fair value disclosures, which we will be discussing in a little bit more detail on the next slide. We were able to classify the different types of disclosures that GASB is requesting into 3 different categories. The first one being, and the obvious one being, disclosing fair values and the different classifications of investments into the levels mentioned earlier. An example of that is on the next slide, and this is just to give you, this is GASB's sample, and just to give you an overview of what the balance sheet may potentially look like. As you can see, they are broken into the various levels, the 3 levels that have been identified previously across all the different types of investments. And Robin here is passing around a handout to give you a picture of the full table.
Small, but it's okay to have it.
It was really small here.
Yeah, bring it up. At least my glasses.
So this table is probably the most easiest to read, so we thought we would use that as an example. The next type of disclosures are around the level 3 type of securities, with the exclusion of securities that are reported at net asset value. GASB is suggesting that we provide additional analysis around these type of securities. For example, a sensitivity analysis for any security that is a level 3. An example of such an analysis would be For example, and this is just a random example, we discount a certain security at 15% based on certain market conditions. If that market condition were to change, what would be the price impact on that security? So such type of information to be disclosed for level 3 securities. The third type of disclosures is being requested for assets that are reported at net asset value. GASB is requesting that we provide information around unfunded commitments and redemption restrictions, or if we feel that an asset will be sold at a different value from what is reported on the net asset value, we disclose that type of information as well. On the next slide, we have highlighted a few of our concerns about the disclosures that are being requested on the preliminary views. The first one being the NAV practical expedient. In the preliminary views, GASB says that we can use NAV in place of fair value.
We're wondering if there
Is
was,
that HVAC or an earthquake?
I think it was HVAC.
You guys must feel it all the time then.
I think even the building is concerned, so.
It's the safest building in Sacramento. That's
It
the
is,
good
yeah.
part.
Because we're in West Sacramento.
Gee, Brian, that really.
Okay, moving on with the concerns.
Sorry. Squirrel.
We're concerned about the NAV practical expedient. GASB mentions that we can use NAV in place of fair value in certain cases, but it has been very unclear as to when we are able to do that. We are also concerned about the relevant disclosures around the assets that are reported at net asset value. For example, disclosing the assumption of an exit price if it's different from the NAV that's being reported. We're also concerned about reporting the sensitivity analysis around the level 3 securities. FASB topic 820 does not require that of non-public entities, and we feel that the cost of providing such information compared to the benefits it might have to a potential user is really, really high. So we have expressed our concerns around that. Our next concern is around validating the various classifications and the costs around that. We will be receiving our classifications of level 1 and 2 securities from our custodians, but the ultimate burden of making sure that those classifications are accurate will fall on CalSTRS. And just to give you an idea, and this is a very rough number, we had about 16,000 securities at the end of June 2013. And out of that, 1,400 securities would need additional research for us to put them into a bucket. Our next concern is the timeliness of issuing the financial statements. It's not only adding a lot to our work, but also it's going to add to the work of the auditors of the financial statements. So we have a concern there of if all of the requirements were to materialize into a statement, we have concerns around the timeliness of issuing a financial statement. On the next slide, I have highlighted some information as a result of the field test that we performed, and this was requested by GASB. This field test was performed, it was basically a mock-up of all the requirements on the preliminary view. This excludes any hours or costs that may be incurred in other units of CalSTRS. It's very specific to financial services branch. As you can see, we have about 6,570 staff hours in the implementation year and 3,916 in the subsequent years. Non-staff cost of $2 million in the implementation year, which includes potentially hiring a consultant to help us with the implementation, additional audit costs, and reprogramming Business Direct because our statements are generated out of Business Direct. The $100,000 subsequent years costs are additional audit costs and any kind of maintenance costs. Upcoming project milestones. We are currently awaiting a redeliberation of the issues that have been raised during the preliminary views. We expect to see that by March. Between late March and August, we expect to see the exposure draft, and at that point, we will have another opportunity to express our concerns. Between September and October, there will be the redeliberation of the issues raised in the exposure draft. And by December, we can expect to see the final issuance of the statement. And if all these deadlines are met, we can expect to see the new pronouncement take effect for fiscal year 15-16. On the next slide, I have included some links, and if you are as excited about this project as I am, you can go ahead and explore.
Can you send us these slides so that we
Absolutely.
will be able to then click on the
Yes.
links? Thank you.
Absolutely. And with that, I would like to open it up for questions.
Harry?
Can you go back to the slide that has the number of hours and costs?
Sure.
So, with the three levels, are they, the number of hours and the cost equally shared between the three levels? Or could one assume that more hours and more cost are associated with trying to get the values of level 3 investments?
Absolutely. I mean, definitely more emphasis is put on level 3 type of securities. Level 1 obviously is the most easiest, but definitely level 3 has the greater share of the hours there.
There is some effort as well to define the securities that go in each level. You know, I mean, some of it's obvious, but as you're considering whether it's a level 2 or level 3, those decisions have to be made.
And as it relates to level 3, so it would be private equity, venture capital, real estate as well?
That's correct.
So that's like, that could be upwards of 25% of a portfolio.
Right. I mean, in terms of maybe dollar values, but if we do a count of the number of securities, that was about 1,400 securities.
So item-wise, it's less than 10%, but value, that's not the case.
And it's based on the manager's assessment.
Well, no, we have a responsibility to understand the investments and then classify them by level. The information that comes into the actual value is going to be substantially based on what the manager provides us. And that's also the issue around the NAV expedient where, and GASB has recognized that in the preliminary views, that in most cases, people are doing the same thing that we're doing and reporting NAV for those kinds of assets. And so the concern that we have addressed in our response to them is, you know, give us some clear guidance as to what qualifies for that, because we don't want to rely on that and then be in a position to have the auditing standards come out and say, no, that's not going to work. And then we won't have done our financial reporting properly.
Thank you.
Tom?
There's a parallel project, I guess, I gather on the FASB side. Is there a substantive difference in how assets would be valued, or the process by which you look at valuing assets?
I don't think there will be a substantial difference in how assets would be valued, but there are some differences in the disclosures that are being requested. So, for example, the FASB guidance requires that companies disclose the transfers between all the levels, but that's not being requested by GASB at this time. So there are some differences.
And the FASB standards are in place. I mean, so people are reporting against those standards at this point.
I have a question. So, so the idea is that you would apply I forget whether it's a sensitivity analysis or is that's the idea. So you would take, say, a real estate investment and say, well, okay, this is valued based on a cap rate of X, but what if the cap rate were to go to Y? And would you then, that would be reported in a footnote so that there would be an aggregation of our real estate portfolio would be valued this much higher or this much lower if the market predominant cap rate were to change? Is that the way we would see this implemented?
Somewhat, yes, but I think our real estate portfolio is very diverse, so we cannot probably group it all together. So there are various types of real estate investments, and the sensitivity analysis would apply differently. So there might be a case we might have to look at a group of certain type of similar real estate investments to be able to perform the sensitivity analysis around them.
So it would depend on, the grouping would be, I think, based on the kind of unobservable inputs or observable inputs that we're relying on to make that valuation, and then the adjustments to those. And certainly leverage in real estate would have
Right.
a different impact than a property where the leverage is not an important component.
So who would make the decision and how would the decision be made as to how much of a swing from our assumptions we would use in doing the sensitivity analysis?
Well, I mean, the standards do allude to the fact that there are going to be requirements issued in terms of the variations in those
Okay,
assumptions.
So GASB will define that for
At a
us.
certain level, and then obviously the AICPA will have something to say about how they're going to review that kind of thing, so that will have, there will be an input there. At this point, well, and as a business, that would need to be done collaboratively between the financial reporting responsibility and the business owner of those particular assets. So we would, we have the responsibility to prepare the reporting, but we don't have the expertise necessarily in all the impact of those changes on the actual investment. So it would be a collaborative process.
And so then somebody who looks at our financial statements could go to the notes and could say, well, actually, if these assumptions were different, the value would really be of, our total asset value would be this much higher or this much lower. And people who wanted to argue that we have more money could say this, and others could.
So, I mean, again, like other standards changes, part of what the impact on us is one of communication, and how do we clarify the differences that people might be garnering out of the information that we're providing in financial statements. And certainly the impact of this potential standard would be significant in terms of the size or the volume of the notes. Let's just talk about it in terms of number of pages. And so then one wonders, and this is just a personal perspective as well as the organizational perspective, and something we wrote in response is, if you give so much information, have you diluted the value of the information because nobody can find what they're looking for?
But
So-
this it would seem to me, give people who looked at our financial statements a better understanding of the assumptions and the basis for which, upon which those valuations are made, right? I mean, because we don't generally report our assumptions for each of those 1,400 investments now. In fact, we don't report really anything except a number.
Right. So that's clearly the objective that the project is designed to address, and the project is following trends that are already occurring in the private sector and internationally.
Grant?
Thank you. So in the actuarial valuation, would we be using different values of the assets than in our financial statements, or is that premature to?
I haven't spent really any time thinking about the link back to GASB 67, but this is really providing the underlying assumption information and not changing the results. The sensitivity analysis might lead somebody to ask a question about our long-term assumed rate of return, but in terms of driving that, I don't see that linkage. One of the things we're wrestling with in implementing GASB 67 is that we've got reporting responsibilities for a money-weighted return, which is different than the return that we're using in terms of the investment assumption for funding purposes. So we're already seeing a dichotomy in terms of the financial statement presentation around that and what we use to drive funding. And, it's just part of the complexity of explaining that these numbers are based on the same set of facts is what it's the same business scenario. We're just picking and choosing different values to do a calculation. And so nothing in the business has changed. It's just we're calculating things using a different methodology for this purpose than we are for this purpose.
Terry?
Thank you. Is a similar process already been implemented or adopted in the private sector and/or international standards yet?
Yeah, so FAS 157 includes these kinds of requirements. So if you look at a private sector set of financials publicly exposed, you will see this kind of analysis. Now, I thought you're in a better position to say exactly what the differences are, but we're obviously focused on our own reporting needs, but I don't.
Yes, I mean, as I was explaining to Tom, that the basis of providing and reporting fair value and coming up with the fair value, the guidance around that is very similar to FASB 157, but the disclosure requirements might be, it's most likely is going to be different. FASB will have different set of requirements from what GASB is proposing.
Thank you.
One of the comments that we made back to GASB is so that when FASB deployed some of these disclosure requirements, they did it in pieces. In other words, they didn't roll them all out at once. And you can see from the implementation impact that from our perspective, it would be much better to have things come in chunks, not just go from A to Z. So that was one of the comments that we made, is to follow that or a recommendation that they follow that kind of implementation approach so that we don't end up having to, come up to 1 million miles an hour over these kinds of reporting requirements in a year.
I don't see any other questions. Dr. Yetman, do you have any pearls of wisdom to?
Just from 1,000 feet in the sky, will this materially change the value of assets that are booked, or is this more a footnote item?
It's a footnote item with the exception of our concern around the NAV expedient. I mean, that's really the area where, in terms of defining when we can do that, use that we would see a difference in financial statement presentation. Again, it doesn't change the facts of the investment. It just might change how we have to present it.
Well, great. Thank you. Thank you very much. This was very helpful. And thank you. So our next item is my glasses on here, is the audit director's update. Mary Ann.
Thank you, Mr. Chairman. I just have a couple of updates for my report. First, we talked about all that recruitment. We were successful in recruiting and filling our vacant internal audit manager position, and I would like to introduce to you our new internal audit manager in audit services, and his name is Kirk Marston. Kirk, can you stand up? Put a face to the name here. Kirk is not new to CalSTRS. He has been with audit services since 2009, primarily focused in employer audits, but Kirk comes with 20 years of internal audit background, having worked for in the internal audit offices of the CHP, the Department of Housing and Community Development, and I'm very confident that Kirk is a good fit for CalSTRS in this position, so I'm really happy to have him here. And then finally, while my work here at CalSTRS has certainly been some of the most rewarding in almost too many years to count, this will be my last ARM committee. I will be retiring as of May 1st. I would like to personally and sincerely thank all of you as the committee, the board, Jack, the entire CalSTRS executive team, everyone at CalSTRS, but most particularly, I'm going to say a shout out to my staff and management with Audit Services, making me feel welcome from day one and placing your trust in me. It's said auditors really don't have a good sense of humor, but I want to dispel that. Since CalSTRS is an educator's pension plan, I thought it was only appropriate that my final comments take a page from a long-standing institution of education. And so my comment is sponsored by the letter P. As CalSTRS is a pension plan powered by professional, progressive, and passionate people that have been a true pleasure to have known and to have worked with. And I'll put a period there, and I'm probably violating an English rule. So with that, Mr. Chairman, that is my director's report. Thank you.
We're going to miss you, Marianne.
We're going to miss you very much. You've done a superb job. It's been wonderful working with you and having you support this committee. And personally, I've enormously enjoyed working with you. I've learned a lot. I've felt that this committee has been extremely well served, and the entire organization has been. So I think I'm sure everybody joins me in thanking you very, very much and wishing you the best in your retirement.
I do appreciate it.
Jack?
And just from all of us at CalSTRS, Marianne really does define leadership when we use that word in management speak. She has 35 years of state service, so she's worked in many places. This was her first experience where she had a formal role relative to a board and the drama and challenge that brings being in a boardroom in this manner and being under the gun each time she does that. But in her tenure here, I can't think of an area where CalSTRS has changed more in a shorter period of time. I mean, we always believe here in continuous self-improvement of the organization and change, but I can't, when the menu of change you brought in immediately, and as you can tell, she sets about it just in a professional manner without raising stress in the organization, but getting it done. And that's hard to do, to create so much change and to have the organizations always in support of it. So you have really finished your great career in the way everyone should finish their career with this work so hard, with a lot of success on your record. And I just can't say enough about that. I'm so pleased you can retire knowing how much good you've done for this organization. So, yeah. So we need to turn back to you. This is one of the most unique positions in the organization that has both independent responsibilities from management and a direct reporting relationship to this committee. And the committee itself has changed over my 12 years or two. I have to say, you have reached a true crescendo in your business-like on a solid approach to it being an audits committee. I don't know if I haven't asked your view of that, but it just seems like we've come so far in how the business has been conducted in this manner. So I think we can now realize that independent relationship and can honor that more with, having your direct involvement in some of finding a replacement. A successor to Marianne, and that won't be easy. As I mentioned, it's a unique position in the state with as you just heard, some of the things that we have to have a financial understanding of are certainly unique relative to other people's experiences in state government. So we're going to have to work together, and I've tasked her to give us her thoughts about that too in the coming months. But Paul, I guess I want to defer to you here what you'd like to do.
Yeah, because we've had, the last week, I've had some conversations with Jack and with Cassandra and with Marianne and with Bob to think about how we go about doing that. And would like to suggest to the committee and see what people's reactions would be to having Cassandra and Bob and myself be a search committee to identify a replacement for Mary Ann. I think that gives us the expertise that Bob brings to us, as well as he is the advisor to this committee, direct involvement from the committee through me as the chair, and then Cassandra, because it is, as Jack said, it's a dual role. There is a reporting relationship and responsibility within the organization, but there's an independent reporting relationship to this committee. So would like to see if people have any thoughts about that, and open it up for Tom?
I think that sounds great.
Okay. Dana?
Go ahead and hit me again.
Oh, I'm
That's
sorry.
okay.
There
There you go.
There we go.
I think that Bob sitting in is an absolute necessity. He's become very invaluable to us, so I definitely agree with that. And I agree with you as chair that you ought to also. My only thought would be that usually when we do interviews and things like that, we usually have two members. So like when we did our fiduciary council, we have two members of the board take care of that. And so would you be willing to have someone else from audits participate in that? And then we have two people from the committee?
Absolutely. I have no problem with that.
I think that would be a good idea.
Okay.
And see, as I'm not on the committee, it doesn't have to be me.
I was just going to nominate you.
I'm volunteering somebody else.
The controller is the vice chair, right? Of this committee?
And we're here essentially co-located in Sacramento area, so maybe that makes some sense.
Does that make sense? Okay. Okay, I think I hear some consensus, so we'll move forward on that. Do we need an action item, or are we just, okay, good. Sounds good. Sounds good. Great. So let's see. Our next item is a review of information requests. I think the one thing we did have is we wanted to get copies of the slides from the presentation on the GASB rule. So make sure we get that. Thank you. And
Electronic.
yes, electronic, so we can click on those, not have to type in those links. The draft agenda for the next meeting, I don't know if anybody has any questions, comments on that. This isn't working. Opportunity for statements from the public. Are there any? Yes.
Yes, I'm Dave Davini, and I'm a retired member of CalSTRS. And I have some concerns, and they're primarily centered in the work of this committee. And what I'd like to express is that as you invest in additional auditors, and as you do your best to train, and as you do your best to get out there and audit, you are bound to get results, you are bound to find exceptions, you are bound to uncover problems. The one thing you should notice is over the last year and the first half of this year, there has been a spike or an increase in the number of appeals, and primarily appeals from retired members. This is a huge problem in my estimation, because we only have 1 year of audit of this nature under our belt. It's a very small sample of the state as a whole. And if you multiply what could be expected result of additional audits, bringing in the same number of exceptions, bringing in the same number of problems, creating the same number of appeals, you have a problem. You've increased the cost to CalSTRS by hiring the audits, by doing the extra appeals, by doing the extra work. You've also increased the cost to districts. It costs the districts additional money to hire attorneys to defend themselves, to prepare for audits, to do the work they have to do to respond to the work of this committee. What bothers me most is that when teachers retire, they retire in good faith, they're out there, and then all of a sudden, an audit comes up, and after being retired for 5, 6, 7, 8, even 10 years, they're faced with a big bill. Now ask yourself what happened. That teacher, when they retired, thought that their retirement was secure, thought that their retirement was adequate. They built their life around that retirement. Then they're faced with a $7, $8, $9, $10, $100,000 debt that they say that CalSTRS informs them that they've been overpaid. The training that went into the district staff, the payroll clerks, the administrators, and others, ask yourself, was that adequate? Was that training what was necessary to prevent problems from happening at the time? Those retired administrators are picking up the tab for mistakes that weren't theirs. And I think that's wrong. And I'd like you to consider what you were doing with this process. Are your audits to be looked at by people retired out there as though the IRS was coming to look at their tax returns? What is it that you're doing, and what is the goodwill that you're creating? Thank you.
Thank you. Is there? I think an issue that you particularly raised was the audit that comes several years after. Can I get a clarification? I mean, is that what is the how does the law apply to sort of the audit results and
I'm bringing up Michelle Henschel. She's done a lot of research in there, collections and statute of limitations involving collections.
We talked about this, I think, previously before about our statute of limitations law. We have 2208B and 2208C. And when it's CalSTRS error, 2208B applies. And so we have that hard line 36-month from each incorrect payment. So usually what happens is when the benefit is corrected, we will go back 36 months and recover the overpayment, reducing to what the benefit should be under the teacher's retirement law and correcting 5% from that corrected benefit going forward. I think the problem comes when we operate under 2208C, which is employer reporting errors. So first, we'll make that reduction to what the benefit should be under the teacher's retirement law, and then we do our actuarial calculation and figure out what we'll collect during the member's lifetime at that 5% and bill the employer for the remainder. Of course, obviously, sometimes those employer reporting errors can be, very substantial. So when I say we're first making that reduction to what it should be under the teacher's retirement law, that can be, depending on the nature of the reporting error, the nature of the compensation, the nature of the assignments that were worked, that initial reduction can be large. But again, from that, it would only be a 5% going forward. We are taking a look at, our statute of limitations law and just communicating to employers, their responsibility to report correctly, timely, and accurately. But for the most part, our statute of limitations law is in 2208, and our statutes regarding collections in general is 24616 and 24617.
Dana?
Marianne, could you speak to, and you might not be the right person to do it, but as we have gone through several of these employer audits, there are things that are leaping out that are reoccurring over and over and over again. And can you speak to the training that we are doing? There you go. I didn't see you, Peggy. I would have asked you. I'm sorry. The training that we're doing with the districts to make them aware that these are common mistakes and you ought not to make them. And then also, how much does our secure employer website prevent some of these things from happening in the future, because that website's only been together for a certain amount of time?
So if you go back and look at Mary Ann's report, and I'm sorry, I don't know the page number, but the report that indicated certain findings where they had 0 in the 11 audits they did, there were no findings of member, non-member. That was a very common finding several years ago, and it caused us to take a very close look at how we're educating employers and what kind of tools employers have in order to report to us correctly. When we established the Secure Employer website through the Employer Reporting Project, we fixed that problem. So I would expect that that won't be a finding in very many audits that are looking at a more current time period. I can tell you from my perspective, the ideal time for us to be correcting those issues on any given member's account is at the time they move to benefit status. But we still have a backlog of issues that will percolate their way through the system until we are at the point where we can do that examination at the point of benefit initiation. That's my objective. That's one of the activities that we're working towards in our data, in understanding our data well enough in our data preparation project will be helping us come forward with plans and strategies for how we can get some of the back stuff taken care of so that we can focus more on clearing the benefit at the initiation period so that we're giving them the right benefit. And there are many ways to do that. We're in contact with other systems to find out what they've been doing in terms of finalizing a benefit. It's an issue that we're having discussion groups in-house about now in terms of how can we finalize the benefit, and then once it's been finalized, is there a need for us to go back and review it? And so we want to address it systemically from a prevention perspective. Having said that, there are still many reporting lines that are there that may have some problems. And despite the training, the directives, the circulars, the on-site training programs that we offer, and all the educational materials that are available to employers through the Secure Employer website, there are employers who make every effort to increase the benefit of members for reasons that are probably valid from their perspectives. They're looking at their own recruitment and retention issues. They're looking at their competitive marketplace with other employers. So I'm not trying to suggest that employers are intentionally and evilly applying, or with malintent, applying some of the rules a little more generously than we may expect to see, but they have often some valid reasons for doing that, and we're certainly not in their negotiations with individuals or with the representatives of those members in their hiring conversations and discussions. And so, we always see that information after the fact. We did put together, in addition to our audit program, we put together the compensation review unit to help us isolate some of those issues and identify some of those common themes and problems so that we can provide more information out to employers to say, don't do this, do that instead. We're also seeing that the more restrictive definition of what is creditable in the pension, the PEPRA, 2% at 62, will help prevent spiking and errors in the future, because there's a much more definitive explanation of what constitutes compensation and what does not. Our credible compensation regulation process that you're well aware of and we're having a public hearing about tomorrow, is one that is also designed to help us get better guidelines and direction out to employers to help them report correctly. Because the issue does stem from employers. I mean, employers reporting to CalSTRS, we anticipate that the employers are understanding what the rules are. We're checking for that through the audit process and through the crew process and through the normal communications and the edits that we have in the system. And we are now collecting employment information that we did not have access to in the past. We're collecting, if we have a question, the employers are required to provide us with a copy of the employment contract, the collective bargaining agreement, the hiring expectations document, or whatever it is they have that establishes the individual's working relationship with the employer, so that we can validate that what they're providing to us is consistent with what's in their contract, and that what's in their contract is consistent with how things should be reported in the law. There are many, many gray areas and many ways that compensation components can be characterized. And it takes our staff sometimes a great deal of investigative work to figure out how all of those pieces interact together to see what was appropriate and what was not. I'm confident that we're doing a lot to help educate the employers. Obviously, we still have more work to do in that area, and we're up for that task. We're also anticipating that through the activities that we're taking now with the additional credible compensation regulations, with the implementation of PEPRA, with the planning and design for the new pension administration system, with the imposition of penalties and interest for late and incorrect payments, that we have a path forward that gets us to more accurate, timely, and complete information from employers so that we can make a benefit determination that is accurate and the members can rely on in confidence. I certainly understand Dave's perspective that if someone's been in retirement for several years and then is told of an adjustment that's necessary, whether that adjustment is to increase or to decrease the benefit, it can be disturbing news. And you might think that, well, how could an increase be a disturbing piece of information? It could be that members have made business decisions or personal decisions that didn't count in income that they would have made differently and created a different lifestyle for themselves. Or it could trip a threshold that puts them into a different eligibility bracket for some other services that they may be receiving. So even though you think that more money is always good, it isn't always good for our members. And certainly when there's a reduction for people who are on a fixed income and often don't have the ability to go out and generate additional income, it can be very difficult.
I just wanted to add, what Peggy's talking about is something we call underpayments. So sometimes the errors will generate an underpayment to a member, and that can go back several years as well. And I don't think I mentioned, just to clarify, under 2208C, the statute that applies to employer reporting errors, we can go all the way back to the date of retirement, and we just have 3 years going forward from the date of discovery. So those are our two main statutes.
And Mr. Rosenstiel, I think the other question, yes, the statute that grants us the power to conduct audits does not limit how far back we can review. Either there may be auditing guidelines that the auditors follow in any given case, but there's nothing specific in the statute that limits how far they can go back. The collections that Michelle spoke about is limited.
Thank you for that clarification, and thank you for bringing this issue to our attention. The purpose of audits is certainly not to be punitive and reduce people's benefits, but the audit process is also an important responsibility that we have that is one of the tools, as Robin said, to ensure and educate employers about compliance. So I appreciate you raising this with us. And I think we have another public comment.
Yes, Ed Folia, a member of CalSTRS since 1957. So have a lot of investment in my retirement. But I'm representing the California Teachers Association retired members, and I find it really discouraging to see the report that's attachment number 6 under item number 5, and we've got 58 retirees that are going to be hit. And we have 290 active members that the problem can be fixed before they retire. And that's good. And what Peggy's had to say is, I think, is right on. We have to get it at the point when they're retired. We have to better educate also the person who's retiring. They have to know how to read and how to understand their annual statement. Now, I don't want to make excuses for my colleagues that are not retired. But to be a teacher nowadays in California takes a heck of a lot of work. And 11-hour days is not unusual. And the majority of our teaching force are women. So most women have many responsibilities besides being a classroom teacher. Now we're going to only give information to them via once a year online. They have to get their annual report. With all the responsibility that's going on with our teachers and the scapegoating that is being done to the teachers, over a recent study showed that 50% of the teachers are ready to retire or ready to quit. Now we have this situation here where all the districts don't have a lack of the way it was reported, dealing with CalSTRS from a district level isn't a high priority, even though they pay 8.25% per each employee. My concern is this. These districts that are listed here on this page, I want to know what penalties and what interest did they pay for their mistakes. I don't care if it was intentional or unintentional. And when I go to the IRS and I have to do my audit, they don't care if it's intentional or unintentional. Man, they go after me and they charge me interest. I want to know what Santa Rosa, Hollister, Newark, Sierra Sands, Moreland, Los Altos, what did they pay? In other districts like El Cajon and Elm Rock and Yuba City, what did they pay in penalties and interest? Because if you're not enforcing that aspect of it, and my suggestion is that penalty be the 3 years that the employee has to pay when they find that they've been overpaid. I don't see any underpayments at all for this past year, but I see a lot of overpayments. Let's try to be a little bit more sensitive. The victim should not have to pay for something that somebody else did wrong. And right now, 58 victims are going to be paying. Yes, you can say that, oh, well, they got the money. But they got the money under false pretenses. They didn't give the figures to CalSTRS. The district gave the figures. So they should be punished. They should be the ones that have to pay out of their pocket. And the IRS is just concerned if they're saying that we got to get it from the employee, then what we can do, the penalty should cover what the employee would have to pay. And that would keep it, and then you reduce the benefit. Thank you very much. Oh, by the way, I don't know when and where I'm going to get the report on the penalties and also the interest. But maybe it could be at our next meeting, or and if you want to send it to me personally, I'm in the files upstairs. So one way or the other, I really want to know. And if the answer is 0, then this board got a job to do.
The answer is zero.
To the extent that there was misreporting by the employer after the effective date of the penalty and interest regulations, there will be a penalty applied to that late report. So we do have regulations regarding that. Since these, the way I'm interpreting this data, since these will have been a return of contributions rather than contributions due to the system, there won't be a penalty on the money, but the report is subject to penalty. Does that make sense?
Yeah, and that's just the way the law reads as to what,
Right,
how
so,
that's
so because
assessed.
we're returning contributions in these cases, at least as I'm interpreting them from a superficial look at the data, but there would be a reporting penalty. Now, again, the effective date of our regulations was July 1st, 2012. Thank you. The years blend. So we can't go back any farther than
Right.
that, but moving forward, there definitely is a process where as we get reporting adjustments, we have the authority and we do enforce. That was one of the internal audits that was reported to you, the penalty on those reporting lines.
And are those penalties made public?
They would be public information. I can provide them. We have the tools to be able to do that. Now, in these particular cases, I'm not sure how much will fall in that time frame, but certainly going forward. And yes, we do have data on the penalties assessed on a weekly basis.
Okay.
So
I think
staff
that's-
could provide that report to you.
I can.
Okay, that was good. I think that's what, that's what the request was. And we're all in favor of.
Okay, so we can definitely get that. We'll check on these. And again, I just want to caution you, given the dates process, we might
Understood,
come back with
understood
an
that
answer
it's
that,
all consistent with
Right.
what
What the law and the regulations
says and
require.
allows, and that's just what we do. But then that legitimately, should be available information. So, thank you. Dana?
Robin, before you go? Sure. I guess how I thought the regulations read was that once a district was notified that there had been misreporting, they had a certain time period to make those corrections. If they didn't make it within the time period, that's when the penalty accrued. So if a district, am I remembering that incorrectly?
So there is a 60-day adjustment period. So you're right about that, where there's a request for an adjustment, and if we don't get it within 60 days, the re-reporting, so let me go back and check, Dana, in terms
Okay.
of these particular circumstances.
Okay, because I'm thinking if they make the adjustments in a timely fashion, then they might not be penalized. Alrighty, thank you.
Yes, you moved from one side to the other.
I'd like to make one other comment, and that is that I certainly don't want to leave you with the impression that I am anti-employer by any means. In my earlier life, I was an administrator, and I do believe that had we made the same investment that we made in audits, in training of district staff, and in a better job of preparing for what we're stuck with and doing now, it would have paid greater dividends. I don't think employers are out there trying to do what they can to undermine the retirement system. Employers retire in that very same system. There are some issues, and there are some employers who have done spiking. I certainly would say audit them if you can find them and you can show that they have intentionally spiked. They should repay money. They should be penalized. But the majority of employers out there are good people trying to do their job. They have busy jobs. Retirement is a very small portion of what a school superintendent does in running a school district. And they're busy people, their staffs need training, they need help, and I just don't want to leave the impression that employers are bad guys. it's the wrong impression, it's the wrong message to send.
Thank you. Thank you. Okay, I think we're adjourned. Thank you, everybody.
Super.